Hello guys, welcome to the sharpening session. Today is Saturday, August 21st. Hopefully you guys have had a great trading week. Now the sharpening sessions we do on the weekends because most markets are closed, and it enables us to expand on theories and concepts a little bit more without necessarily being in a rush to place a trade. So it's a good place to come if you have questions and you want sort of detailed answers and you want explanations of things. Of course, the crypto markets are still open. So we could still look at those, but most of the time these are for, again, sharpening the theory and the methodology. So I've got some chat boxes up, so I'll see you guys in different places. You let me know, as always. I want these sessions to be led by you. I want you guys to tell me what you need from me, what makes sense, what doesn't make sense, what you'd like me to look at, what is, you know, what you get, what you don't get. So please let me know in the chat box. I always have a backup. I always have a theory or something to be going over anyway, in case nobody asks any questions. But of course, I do want to make sure that you guys get what you need. So you let me know if there's anything in particular you want me to cover. Now, before we start, let's cover the disclaimers. Those, of course, need to be put up there for legal reasons, but of course it's also important for you guys to understand that these kind of videos are demonstrations of how we use the products, of how we use the technology, and how we apply a methodology to the technology. And of course it's up to you what you do with it. You can ignore it, you can take it on board entirely, you can do something in between. In fact, I would argue, and this perhaps sounds like a weird thing for me to say, ultimately our goal as traders should be to have our own methodology, and I'll expand on that a little bit again today. So a lot of people, when they first learn, will take on board a methodology that they're learning from whoever that is and copy it 100% or as close to 100% as they can. But as we go on, we want to be able to test different things, try different things at the time when we're available, with the risk tolerance that we have, play about with different components of methodologies so that we can get to a point where we are comfortable 100% doing something that makes the most sense to us. So hopefully that makes sense to you guys. Now let's just go through the agenda. So we'll do sort of lecture time. We'll go through trades and trade plan reviews if appropriate. Mainly Q&A is what I'd like to cover in these sessions, but otherwise, like I said, it will be methodology focused. Now, we are streaming in multiple places. This is true of nearly all of our sessions. We are streaming on YouTube and LinkedIn and other places as well. And with that, that means that some people are accessing us for free and some people are inside our closed coaching community watching us in there. Now, what's the difference? If you pay for the closed coaching community and other people can watch it for free, that seems a bit weird, right? The reason we do that is because around about halfway into the session, we'll cut the stream to the free ways to access us, and we'll continue in the closed coaching environment. So basically, the closed coaching environment is for people to have access to more of our time in that closed environment where they can ask more questions and things like that. So around about halfway, normally during the week when we're trading, it will be after we place at least one trade. In sharpening, of course, we're not placing trades most of the time, so it's going to be after a point or after the close of a question or something like that will be where we cut off, and we'll continue in the closed coaching. Okay, so let me just go quickly to a link here, which is tradewithufos.com/Becky. Now this is a great link because from this link you can set yourself up with a free Trade with UFOs membership, and then you can come down here and ask questions in a public area, which allows other people to see the answers. What it also does is allows me to expand on those answers in the sharpening session. So special thanks to Steve. You've been posting loads of questions on here recently, which is great because it helps other people to learn from these questions and learn from the answers. So everybody else as well, if you have questions, by all means, of course, you can email us directly. But otherwise, this is the best place to do it because then we can answer the question in public, other people can learn, and we can expand on it. In fact, I have a question ready from what was on here before, or a previous question, to expand on the answer for today's session. But before I do that, we actually have something, or I have something sort of fun and exciting to show you guys. It's not fully ready yet for you guys to be subscribing to or using, but I want to show you this. Now, if you follow Jose's sessions, the options with options sessions, he uses Top, but I just want to show you this. This is basically our own platform, which is really cool, really exciting. Now, for those of you that use TradeStation, You might notice it's perhaps similar in terms of the layout to TradeStation, but what's great about this is that it essentially integrates with what we do, with what our methodology is, which to me is the most exciting point. It's like any other platform in the sense of you can format things and you can change the style of the you know, the candles and different themes and things like that. You can add different studies. So add different indicators and things like that. And as you can see, there's loads of commonly used ones. You can also see that our UFOs and climate, by the way, UFOs has recently been granted a patent from the US Patent Office, which we're very excited about as well. So you've got those there as well. Again, all integrated. Now, one of the things I really like, and I'll be using this in my stock sessions if you guys follow me on here. So if I come over here to Matrix, there is a scan. Now we use scans on TradeStation in order to scan for stocks, and you can also use them to scan for other things as well. But what I really love about this scan is that we can be looking at AutoClimate as well. We can be using the technology that we use integrated with this scan so that we can see what makes sense to look at. So for example, I wanted to show you this today before we move on to that other question. Let's say you're scanning for stocks. What's really cool about this is top point gainers. Let's go to all stocks. So we're now scanning all stocks. This is just a scan number 1. We'll ignore scan number 2 for now. Let's say you want a minimum price of $20 and a maximum price of $200. Okay, so I'm making up that number, okay, with whatever you guys might want to do. We'll leave the minimum average volume at 300,000 per day. That's enough there. We're looking at US stocks, so let's look at ETFs as well. So we're looking at stocks and ETFs. And again, so far this is no different to scans you might use on TradeStation. Now, you can filter by stock rotation or strength. Again, medium strength, you might say you want it to be a strong upward strength or a strong upward strength, long term or medium term. Let's ignore these for now. You can come to earnings and you can, let's say for example, we want to exclude stocks that have earnings coming out within the next 10 days. That would be assuming that you're a sort of mid-swing trader. So you might have trades that last a couple of weeks, which means you don't want the earnings to bother your trade in a sense. Let's say you're a shorter term trader, you might do next 3 days. Longer term traders, you might put 30 days or enter in a specific date range. Let's go for 10 days. Then what you might want to do is come to AutoClimate, and this is what's really cool. You can say, let's say for example, you're using daily. You're using a daily chart for your common time frame. That might mean you're using a 55-minute chart for your entry time frame. If you're using daily for your common time frame, then you want to be able to get into a trade that's near the 9 EMA. Now what you also might want, I'm just going to check that up here, what you also might want is to know that the weekly is early. Now what we mean by that is that if the stock is going in an upwards direction on a daily chart and you want to get into that, brilliant. What if that stock is also at the very start of a weekly uptrend? Or a weekly, if we're talking in climate terms, it's right at the start of an upwards climate. That way you have an extra variable that you can use here to go in your favour. You don't need it to be the 9 EMA, near the 9 EMA on this one. That's not the methodology. It's just an extra thing going in your favour. And then you can click scan. And out of all of those thousands of stocks, it's now given us 3 stocks that fit that criteria based on the methodology that we use and the technology that we use. And then we can go and check this out and we can go and look at these particular stocks. Now, as we know, we're not actually placing trades in this session, so I'm not going to go and look at these stocks and analyze them. Things might change during the week anyway, but I think that's a pretty cool thing that we can start to scan things now based on AutoClimate, which is pretty awesome. Otherwise, as we see here, if you're using stocks or futures or Forex, you can lay it out pretty much the same as we'd lay out any other charts, use any other things. The fact that it's integrated with what we do is what's really special about this. And if you trade options in particular is where this comes in really handy. But Jose is much better at explaining that than me, so I will leave that to him. So I just wanted to show this to you guys. And again, it isn't out ready at the moment. It will be soon, but I just wanted to show it to you. Okay, so what we're going to do now, oh, I just saw a question. Sorry there, Steve, I didn't see that. Is it able to scan for symbols that are near a UFO in the edge time frame? Do you know, that's a good question. Let's have a quick look. Let's go to additional filters. I don't think so is the answer, but No, it doesn't. I don't see anything here that says about AutoUFOs, but that is a really good question. I'm not 100% sure on the answer. There might be another way to do this. I've only just been using this for the last day myself, playing about with it. So Jose is going to know the answer to that 100%. So I can ask him and he can explain it on another session. The short answer at the moment is I don't think so. So hopefully that helps answer the question. So yeah, it would be nice. It probably is possible, Steve, just looking at your comment there. It would be nice, because then what we could do is we could go to here and we could filter by, let's say, for example, stocks again. And let's say, again, stocks and ETFs. Let's give it the price range. Let's do 10 to 100. Again, I'm making it up. You guys will have your own things that you do there. We can then come to auto climate, check these things. So now we know that whatever we're looking at, if we now scan this, whatever we're looking at, oh, I didn't put in a earnings thing, so let me go and have a look at that. And we know that whatever we're looking at is pretty much going to tick most of our boxes when it comes to our trading rules, right? So there we go. I must have not put in something. Oh, I've put in different numbers, that's why. Okay, so of course, what would be great is to know that these are all trades, or filter down further. Let's say there was a auto UFO one here, that we could click on that and we could say, show me where there's a UFO on the edge time frame. Now, perhaps because with the edge time frame, it depends on what calibration you use as to where you'll see the UFOs. So perhaps that's why it's not so simple to just have that as a filter in that way. But at least we know that we're going to be looking at things that have strength in a certain direction, not just in, if we go to stock filters, we could also say we want it in the group that it's in to also be strong upwards, which is great. And again, we can filter by those things. And then that last bit of the puzzle is the bit that we go and look at manually, depending on which calibrations we use. So hopefully that makes sense. Cool. Alrighty. So let me just go back then, Steve, especially because I believe this was your question anyway. So the question was, the question about climate, extended or not. So I'm just going to read this and then I'm going to go back to, I'll go to TradingView today so I can expand on this and explain it. So if I see, for an example, an extended downward climate, so red circles, broken up by one or two unconfirmed blue circles, would that be considered less probable of a trade than one where there is a clear separation between trends? I've attached an example. I know the methodology has me looking at the latest circle, but would a more advanced trader say the small blue circles are not a clear enough change of climate, and as a whole looks like a very overextended downwards climate? So it's a very, very good question. So let's take this as an example. So see, we had this situation here is probably better. Between the 20th of May, in fact, let's see if we do this. We'll just look at this main one here. Brilliant. So in this situation, from the 20th of May here, we had the start of an upwards climate. And actually, it continued to go up. It dropped down a little bit here, which is kind of where it meets this point here, right? And actually, that was a little bit of a pause. We had a confirmed downwards climate, and then it continued up from there. But let's take this run, this specific run here, okay? That's really bad drawing. So let me do that again. So this specific run here is what we want to look at. So between the 20th of May and this point here, which is the 14th of July. So from this point to this point. Now during this upwards trend, during this upwards climate, we had moments where we had a thin red dot, we had two thin red dots, we had one red dot. And all along, it was still really going up. It became confirmed upwards again the next day, confirmed upwards again the next day. So that's a very good point that in a sense, what these little red dots were essentially a pause along a greater upwards trend. However, we don't know when it's a pause. Let's say, for example, we see 2 dots. We could see 3 dots. We could see 5 dots. We could see 4. We need to be specific on how many of those opposite colour dots that are thin, how many of them need to be present before we call it a proper break of the climate. If it's just the one, so let's say, for example, in this case, let's say you said 1, then after this point, where this second one appeared, then you would say, okay, end of the uptrend. and that way you had one break, a small continuation, and then the end. If you say it has to be 3 or more is what breaks it, then everything up to this point, well, actually everything up to this point was I just lost my thing. Everything up to this point here, where this third dot appeared, everything there would have been considered an upwards trend. The thing is that what we can then do, so these numbers tell us what is happening in terms of the thick dots, right? The confirmed dots. So if this tells us it usually goes up for 7 candles, and then we have 3, then that's telling us 3. It actually doesn't include the unconfirmed dots, but what it's doing is, let's say for example, here, 1, 2, 3, 4, 5, 6, my eyes are funny, 7, 8, 9, 10, 11, 12, 13, 14, 15. I'm going to call it 20, okay? I'm going to call it 20 because my eyes are getting weird looking at this. Let's say this was 20. So all along here, that was 20 dots. Then we had one break. This one would have told us we're on number 1. Whereas Steve's point is actually you'd be on 22. If you essentially ignored that dot in the middle, you're still continuing the same trend, and therefore this dot has less validity than perhaps this one did, or than perhaps this one did, because of what came before it. What came before this was one break in the context of 20 upwards candles. And if we know that the market usually goes up for 7 candles, well then if it's been going up for 20 on this day, we would be saying no, that's way too far. And it did then break, it paused, before it then went back up again. That candle would have told us number 1 out of 7, and then it broke again. So in a sense, this specific example sort of proves the point, that by the time you'd come to this candle, you would see 1 out of 7, and therefore you would see that it has greater sustainability, but then you would have seen a break in the climate. And then it would have obviously continued for a new one. Now, again, there are different ways of looking at it. The most important thing, my second screen keeps flashing at me. It's very distracting. So the most important thing is that if we have a rule on this, that we stick to it all the time. So let's say, for example, our rule is simply look at the last one. So this one is a thick red dot. It's 3 out of, in this case, 3 out of 3.37. Let's round that up. This is 3 out of 4, and we analyze it based on that information. Now, what we could be saying is, okay, right now that's not an issue, but let's say we were here. If you're going to decide that the thin dot of the opposite colour essentially doesn't count as a break if it's just 1, then you would have to go and count all of these and put that in the context of the sustainability. So let's say these were 20, then you would add 1, 2. So you're on 22 out of 7. And then again, you may have different rules on whether or not you're okay to take those kind of trades, or whether or not you reduce your risk on those kind of trades, or put your targets closer on those kind of trades. There's nothing to say you have to rule them out entirely. You may choose to be less risky or more conservative about the trades you place in that context. If you say it has to be 2 or more to count as a break, well then that would mean this one starts at 1 again. You then forget everything that came before it. If you say it's got to be 3 that's a break, in which case then all of that counted as 1 trend, as 1 climate to the upside. So it depends where you're putting your rules. If it's 1 break, then it stopped here. If it's 2 breaks, then it stopped here. So when we're doing this, we just need to be really, really clear. If we're going to use those thin dots as a continuation, really, a pause of a climate, as opposed to the break of a climate, how many of them count? And a very strict rule to have would be, if it's a thick dot that's the opposite, that always breaks it, because a thick dot tells us that we have confirmation to that side, which means more likely than not it's going to continue in that way. Not always, as we see here. We had a thick red dot here, and then it continued upwards. And again, that can happen. These numbers come from averages, right? So we get an idea from hundreds, thousands and thousands of pieces of data that say averagely it might go up 20 times, it might go up 3 times, it might go up 7 times. Average that all out, it goes up 7 times in a row, or 7 candles in a row. So I would say if you're going to have a rule on this, the opposing dot, if it's thick, should always mean that the trend is broken, the climate is broken. If you're going to use the thin dots as part of a trend continuation, just be clear on how many of them count. Could be 1, could be 2, could be 3. With all of this, again, it depends. If you use 1, what you might do is rule yourself out of more trades. If you use 3, so let's say, for example, you say it can have 3 thin red dots in a row, as long as the next one's blue, I'm counting them all as if they're blue, then you're going to rule yourself out of trades because you're going to have more blue dots. And if you're going by sustainability rules, in this case, you'd have 20 something, 30 maybe. So you definitely wouldn't take that trade if you've got rules about sustainability that says you won't do that. If it's 1, well then after 2, and then it starts again. So you get into more trades. Like everything, it's quality versus quantity. If you rule yourself out of more trades because they have less probability, then you save perhaps efficiency rating, but you might miss out on opportunities. If you have more lax rules that allow you to get into more trades, you have more opportunity to make money, but you may be getting into trades that are lower in probability and therefore your efficiency rating is hit. It's always a balance, one or the other. So I know I went into this in lots of detail, but hopefully that makes sense there for Steve's question. I know you kind of got the answer anyway, Steve, but it was a great question, and I think some people might get confused about these kind of things. It's also, just to expand on this as well, actually, because I think you asked one of these questions before as well in a session, which is a great one. What if you're in a trade? If you're in a trade, let's say you got into a trade here, which would have been a nice place to get into a trade, because you could have then ridden this all the way up, right? Perhaps even got out somewhere up there, right? Let's say you got into a trade here. Well, by this point, by the time we had this red dot, if you follow the rule of get out of the trade when you have a change of climate, then you may have gotten out of the trade here. Now you've made a little bit. Let's say you got in here and you got out there. Okay, great. You made a little bit of money. This is a daily chart, so that took a little while, and you may have made, I don't know, $12, $13 per stock, which is okay. Depends on how many stocks you have. If you just got the one stock, then it's not too great in terms of an hourly pay, right? Now, if you were to say, no, this doesn't count as a break until it's 3 of the opposite, well, then you were still in this trade until this point. If you were in this trade until this point, then if we do this, depending on when you got out, you could have got out at a little bit earlier a point and actually made a little bit more money. Again, that can go in your favor to allow you to be in trades and continue that trend for longer, because you see these opposing thin dots as breaks as pauses rather than breaks. If it's a pause in a greater uptrend and you're in a long position, you might want to hold on to it, and so you can continue and perhaps take more out of the position. The negative thing is, let's say, for example, in this situation it carried on upwards, but it could have done another thin dot, and come down, and then by the time it's a thick dot, let's say this one was now a thick red dot, you might have lost by that point. You might have come back to break even by that point. And so getting out here, the first sign that you see that the climate is no longer confirmed in your direction, you protect yourself from the downside. You might get yourself out of opportunity to the upside. Again, it's a way up that each individual trader has to make. For some people, it's more frustrating to be, let's say, more conservative and say, okay, we no longer have everything looking the way everything lined up in the way that we want. If it's no longer lined up in the way that we want, I'm going to get out. And perhaps it's frustrating to then see it go your way. For other people, it's frustrating to have perhaps ignored signs that it wasn't quite going to go your way and then ended up losing. That, again, depends on the individual person. For us, we're stricter on this. As soon as we see a change of climate, the rule would be get out of the trade. As soon as we see, if we're looking at getting into a new one, we're very, very strict and very simple, I guess, in that way, in that if this is the first thick blue dot, it counts as number 1. Again, you can change the rules on these. It's ultimately up to you guys to decide how you want to interpret this data. For us, we interpret it as black and white as it is. And that makes it easy to apply. There might be pros to that. There might be cons to that. Overall, if it still makes us money, great. For you guys, it might be that you're stricter on certain things or more lax on certain things. And that's okay. As long as you're still making money, great. Doesn't matter. If it's easier for you to do and it's easier for you to sort of comfortably, what would be the word? Enact it, right? Day by day. That's the most important thing. If us telling you, get out at this point because the climate's changed, if us telling you that stresses you out because you, more times than not, perhaps you see that it would have gone more in your favour. If that stresses you out, you're not going to do it anyway. And if you're not going to do it anyway, then you're not going to be consistent. And if you're not consistent, your results won't be consistent. And you won't know what's working for you and what isn't. If us telling you to get out at this point, because we no longer have everything lined up the way we want it to go, if us telling you that is comfortable for you, then great, keep doing that. If you're okay to see it sometimes go in your favour and sometimes actually saved you to be a little bit more conservative and overall you're happy to implement it that way, great. So, okay, good. So I kind of see it, I'm just going to make a quick analogy for those that might be wondering exactly what I'm trying to say here. Let's say you own a business. Okay, let's say you own a restaurant business. And just at the start of COVID, before we knew what was going to happen with it, there were signs that we might be in a situation where restaurants might need to close. Some people would have gone, I'm sure it will be fine, let's ride it out. And some people will have gone, sell the business. For those that sold their business, they perhaps saved themselves a lot of issues through the pandemic. It could have been the other way around. Let's say we had sort of the inkling that something might happen and then it was squashed really early and somebody's jumped on, knee-jerked, sold their business and ended up selling what could have been a really successful restaurant business because they were scared of something that could happen. That never happened. Ultimately, we say the person was right based on what then happened, but either assumption, either decision could have been right or wrong. What's most important is that if the person did that, if they sold their business and then there wasn't a pandemic, they might be kicking themselves that they did that. But if they didn't sell their business and there was a pandemic, how would they have dealt with that? How would that have impacted them? Would they have been able to survive it? And so again, this is what we're doing, and it's obviously a smaller situation on individual trades. But what we're doing by seeing here is this red dot, to use this analogy, could have been the start of the pandemic, right? This could have been the start of something that could go against us and lose us money. And so we have the decision to sell out now and perhaps save ourselves the downside, or to ride it out and hope that that's probably not the pandemic. And in this case, it wasn't. Perhaps in this case, if it started to fall like this, then it would be. And so we would have rather got out here than waited until we were proved wrong and had to get out here and lost in the lead up to that. So, very morbid example, but hopefully that makes sense again as to why we make the decisions and why we won't. Right, what I'm going to do now is cut the stream to the free sessions, so YouTube and LinkedIn and Facebook and Twitch and wherever else we are. We keep adding to them, I keep forgetting where we are. So I'm going to cut the stream to those. I'll stay with you guys in the closed coaching community, so you let me know what questions that you have. I am going to do that now. It takes me a couple of seconds to come off these live streams, so I have to do them one by one, so bear with me if you're in the closed coaching one. And for those that have any other questions, go to tradewithufos.com/Becky, put your questions here, and then I can expand on them in sharpening sessions and of course help you guys out with anything that you have, or you can email me if you'd like, becky@traddictiv.com. So give me a sec, I'll be with you guys in a minute, and for everybody watching on the sort of live streaming sessions, have a great rest of your weekend. See you soon.